Hello everybody, welcome to another video in my video series, The Profitable Investor. My name is Mark, and this is a video series I created to help you become a better investor. And in this video, I am going to talk about the stop loss order, but even better, not only am I going to show you how to set it up, but I am going to share with you one of the strategies that you can use as an investor and how you can use stop loss orders to protect your money while you make some money in the meantime. So here is a nice ETF here. It is DUST, D-U-S-T, and it is an ETF exchange traded fund, and it is leveraged 300% to the index of the gold miners, meaning that it uses contracts, futures, swaps, and so forth, shorts, to perform 300% of the gold miner index. But this is the inverse one. Okay, now if you wanted to buy this stock, you can see it is trading at $29.51 right there. I blued it out. And so you would go here to the buy, and then you'd put in, let's say, 100 shares like that, and you'd buy it. But I'm not going to place the order. It is after hours, and I'm not going to buy this at this time. I'm just doing this video as an example. Now, let's say you own the 100 shares and you want to set up a stop loss order. So you own 100 shares at $29.51, and let's say you want to set your stop loss at $28. So you go here to the order type, and you see you have four choices. You have stop market, stop limit, and then you have trailing stop percent, trailing stop money. So you go to the stop market, that's the most basic one, and then you put in $28 like that, and then you would put in your 100 shares like that, and you hit review order, and you can see this. It says over there on the left, stop market with an activation price of $28. So that means if the price of this stock goes down to $28 or lower, then it will sell at that stop loss. Now, you may end up selling lower than $28 if it gaps down, but at least you'll get out of a losing stock. So that's the basic idea of how stop loss order works. And I'm going to go back here really quick, and you can see there are four choices you have. You could also do a stop limit, you could do a trailing stop percent, and you can trailing stop $. And if you want to know more about those, you can easily go on investopedia.com, look that up, or do a Google search, watch some videos on those things. But the stop market is the most basic one. It just means that you're going to sell your stock anytime the price of the stock hits that price or lower. Okay. Now, how can you use stop loss to help you make money? Well, I picked this stock. I should say ETF. It's an ETF because it is very volatile. And if you want to be a short-term trader, then you want to find stocks or ETFs that are volatile. So let's pull up the chart here. And this is a 6-month chart. And I'm going to set up my trend lines so that I can graphically show you. Now, in the last 6 months, at the making of this video, it is March. Actually, it's April already. Wow, this year is flying by. It is April of 2017, and you can see in the last 6 months, it's hit a high of $70, and it's hit a low of under $30 at 25. So that is super duper volatile, and that is what you want. And you can see within that time frame, it's had a down time of there, it's had an up time to there, and then it's been a little flat there, and then it went up again, and then here it went down, and then it went down again, and then it went up, and then it went down. Now take note here, okay, like on this time right here, you can see that the up time was from about the $30 level up to the $50 level. So if you bought 100 shares, then you would have made $2,000. And from this part, it went from $50 up to $70. So again, you would have made $2,000. Okay. Now down here, okay, this is where your stop loss would come into play. Now, the strategy that you might want to use is a simple moving average. So let's block this out real quick and let's get rid of our trend line so I can show you from the start how this works. So first you go to your indicators, you put in SMA, and then you want to put in just the simple moving average, right? Oop, I deleted it by example, or by mistake, sorry. So you would go to here and you'd get rid of this. You just want to put in the simple moving average. And so there's your simple moving average line. So that is a 10-day simple moving average. That just means that's the average price of the stock in the last 10 days. And you can see the line kind of follows the pattern of the stock. Now, let's say your strategy is anytime the price of the stock, and let me pull up my trend lines again, anytime the price of the stock goes above the simple moving average, you'll buy. And anytime it goes below it, you sell and you get out of your position. But the key is each time you buy, you set a stop loss order. So let's start from the beginning. So here looks like you might have bought and you might have lost a little bit. And you would have bought at looks like at about $40 a share. Maybe you would have put your stop loss right there. And so you would have lost a little money. But that stop loss would have saved you from going way down here, right? And then here you buy again at about $40, and then the price of the stock never goes below the simple moving average until right around here. So you would have made, looks like about $1,200, okay? And then you would get out, and then you'd stay out, and then maybe you'd get back in right around here, looks like at about $55, and then it would go all the way up here, and then here is your get out, so it looks like about the lower 60s, 62, so you'd make another $700, and then the price of the stock plummets and you would be out, because your whole strategy is to buy when it's above the simple moving average and to sell when it's below, and then you'd be out. Maybe you would get in right around there. As you can see, it goes up, and then you might lose a little bit, and then maybe here it looks like you get in, and then here you get out, okay? And that is almost about an $800 level, okay? So that is a basic strategy. It's a common strategy. It's not like some secret strategy. Now here's the key here. This red candle here, this big red candle there that I'm messing around with, that's looks like the time where using this strategy your stop loss order would come into play. Because let me clear these out real quick, clear the trend lines, and I'll pull up my trend lines again. Because as you can see, the simple moving average is going up, and then right here there's a green candle, which means the market's going up, and so you would have bought at about, looks like $38, but then you would set your stop loss right down here. I'm sorry, let's get out of that. You would set your stop loss right down there, which would be at about $36. So you would have bought, and maybe I should use a smaller chart. Let's go to 3 months there. Maybe this is a little easier to see. Okay, so you would have bought right there, and then it looks like it went up to about there, but you would have, if your rule or if your strategy is to hold unless it goes below the simple moving average, it looks like you would have lost some money. And maybe you would set your stop loss like right there. So you might have lost a couple $100. But as of today, look at where the stock is. Okay, so this is all the money that you would save. You would have saved yourself, looks like about $500 or $600. And so going back to the 6-month chart, if your strategy is to use this 10-day simple moving average, you would be having a very good month because you would have made a lot of money here. You would have made some money here, you would have made some money here, and you would have took a small little loss there, and then there was one other spot that I thought you might have lost, maybe like right around there. So you would be having a very good month. You'd be up, looks like 8, 16, you'd be up about $2,000, okay? And the key is each time that you pull the trigger and you buy, you always set that stop loss order. So here, you would have set the stop loss there, and you would have bought there, and here you would have set the stop loss like down there, and like here. You might have set your stop loss down here, okay? Just in case, because when you use a strategy like this, simple moving averages or technical indicators, there's no causal relationship. It isn't cause and effect. The simple moving average doesn't cause the price of the market to go up. It is simply a statistical indicator that people use to buy and sell stocks. And the stop loss order is a protective strategy so that you can stay in the game in case it goes against you. See, now imagine if you would have bought the stock here and you would have just held and never set a stop loss, okay? That's at about a $52 level, $53 level, and then it would be going down to $30. You would have lost, like, looks like about a couple $1,000s. So that's the reason why you might consider using a stop loss order. Stop loss orders, the only people that don't use stop loss orders are the long-term investors that buy and hold stocks for years. Every other kind of investor uses a stop loss order. That includes the day trader, the swing trader, the forex trader, the futures trader, the options trader, and the short seller. All those kinds of traders, or investors I should say, use stop loss orders. The only person that doesn't are the long-term ones, okay? But if you are a long-term investor and you buy and hold stocks, and then there's a recession going on, what kind of return are you going to get on your money? Answer? That's right. It's going to be a negative return. You're going to go in the red. So long-term investors are good while there's a bull market, but if there's a bear market or a recession, then you're going to have to take your losses. There's no getting around it. But if you're a short-term investor or trader, then those stop loss orders are going to protect you, and you could even make profits during these down times. If you're a short seller, and let's clear out this trend line. If you're a short seller, bring up my trend line again, and then you would sell the short here, look at all the money you would make. You would make all that money because you would be selling, I should say, you would be selling to open. And when you're a short seller, you borrow shares from your broker and you sell them to the market at this price, which looks like at about the mid $60 levels, and then you would buy them back all the way down here at about the $30-something level. So you'd be making $2,000 in profit. So short sellers profit when the market falls. You know, so when you decide to become an investor or trader, and I'm not saying that this is the only way to make money, but it is a very legitimate way to make money. Long-term investing is not the only way to make money, but the key is to use those stop loss orders. So if you were to sell short up there, you might set your stop loss like up there. You know, that way you don't risk losing all your money, which could happen if the market went against you. So stop loss orders are a very, very good thing to learn about. It's one of the three main ways that you can use to protect yourself. The others being position sizing, and the other one would be hedging. So get comfortable, get familiar with stop loss orders, and you can come up with strategies like this. If you don't have the personality or the emotional whatever to invest this way, then go find a different stock. Go find one that's not this volatile. Go find one that's less volatile and invest in that one. But consider using stop loss orders as part of your strategy, and it will serve you well. So that's it for this video. I hope you enjoyed it, and I will see you in the next video. Thank you.